Imagine you authorize the purchase of this massive state-of-the-art piece of factory machinery
Yeah.
for your subsidiary in Japan.
Right.
It costs 1,000,000 yen. The machine arrives, gets bolted to the floor in a warehouse in Tokyo, and it just sits there, completely untouched.
Gathering dust.
Exactly. Then, 3 months later, your corporate headquarters in New York reviews the books. And because the US dollar just happened to weaken against the yen over that specific quarter, headquarters legally claims that machine is suddenly worth twice as much on paper.
Which is wild.
Right. I mean, there are no new parts. There were no upgrades. It hasn't even been turned on. You have generated pure phantom profit entirely out of thin air, dictated completely by the global currency market.
Yeah. And welcome to the murky, high stakes, and honestly, incredibly lucrative world of multinational accounting.
It's just crazy. So if you're listening to this right now, you are likely an MBA student staring down a deeply intimidating chapter titled Accounting for Multinational Operations.
That's heavy stuff.
Yeah, the coffee is cold, the exam is looming, and you were trying to memorize a mountain of formulas. Consider this deep dive your survival guide.
Absolutely.
We are not going to just read off bullet points for you to highlight. Okay, let's unpack this. The journey we're going on today moves from the big picture of why global accounting is a complete mess down into the attempts to fix it, and then into the actual nitty-gritty math.
The consolidation and currency translations.
Exactly. And finally, we'll look at how corporate headquarters use accounting to basically control their global empires.
And I want to reassure you right off the bat, providing the what is easy, right? Any textbook does that.
Right.
We are going to dissect the why. Why do these specific frameworks exist? Because, once you understand the underlying logic, the formulas themselves become incredibly intuitive.
You stop trying to remember the math and start seeing the strategy.
Exactly. You want to understand these mechanisms for the corporate boardroom, not just to pass a test. Because rote memorization might get you a passing grade, but misunderstanding this stuff in reality, that's how executives get fired.
So true. So let's start with the foundational philosophy. Before we can even debate how to, consolidate a global financial statement, we have to look at why accounting is such a chaotic puzzle globally.
It really is a puzzle.
As a business student, you inherently think of accounting as a static truth. A dollar is a dollar, right?
Right, but the source material gives us two very distinct definitions from major institutional bodies that completely complicate this.
Right. The first one is the American Accounting Association.
Yeah, the AAA. They define it as the process of identifying, measuring, and communicating economic information to permit informed judgments.
Okay, so informed judgments.
Yeah, focus on the verbs there. Identifying, measuring, communicating. It establishes accounting as a dynamic process, not just, a historical vault.
It's active.
Exactly. The numbers only have value if they actually help someone make a decision about the future.
Okay, and then we have the second definition from the American Institute of Certified Public Accountants, the AICPA.
Right, and they take it a step further.
They do. They define accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events, and interpreting the results thereof.
I love that they use the word art.
Wait, really? Why?
Well, because using the word art completely destroys the illusion of this objective, universally applied science.
Oh, I see.
It openly admits that human interpretation is basically baked into the very DNA of financial reporting.
So the accountant is making subjective choices.
All the time. They choose how to classify an event, how to summarize a quarter, how to interpret a loss. The financial statement is serving multiple masters at the same time.
Like who?
Well, top management uses it to prepare budgets. Owners use it to gauge business health. And of course, the government uses it to calculate taxation.
Which opens up a massive problem the second you cross an international border.
A massive problem.
Because if accounting is an interpretive art designed to help people make decisions, the really obvious question you're probably asking yourself right now is, why hasn't the global economy simply adopted one single universal rulebook?
It seems like it would solve everything.
Right. It would make cross-border investment infinitely smoother. The friction seems entirely self-inflicted.
Well, the issue is that a universal rulebook assumes a universal audience with universal needs. And that is just a fantasy.
So the needs change depending on where you are.
Exactly. The purpose of a financial statement actually mutates depending on the geographic soil it sits on.
Okay, break that down for me.
Sure. So some of the major research on this illustrates it perfectly. In the United States and the United Kingdom, financial statements are primarily engineered as performance indicators.
Because of the stock market.
Right. The target audience is the individual equity investor. They want to see aggressive growth, profitability, future potential. They want to know if they should buy or sell stock.
So the American reporting style is essentially a pitch deck for future capital.
In many ways, yes, exactly. But if you travel to Germany, Switzerland, or Japan, the primary audience shifts entirely.
How so?
In those nations, businesses have historically been funded by massive banks, not individual retail investors.
Oh, right. And banks have totally different priorities.
Completely different. Banks do not care about aggressive hockey stick growth. Banks care about stability, risk mitigation, debt serviceability.
They just want to know you can pay back the loan.
With absolute certainty. Therefore, the accounting reports in those countries are designed for taxation usage and bank assurance. They are inherently conservative.
Wow. So you are trying to compare an aggressive equity pitch to a conservative bank audit, but they are both legally labeled as financial statements.
Exactly. And if we connect this to the bigger picture, accounting isn't just math. It's a cultural and political artifact. This is why investors and governments struggle to compare cross-border firms.
It's not just translating yen to dollars, it's translating entirely different financial philosophies.
Yes. And to understand this structurally for the exam, you need to know the 5 specific variables that dictate how a country's accounting system evolves.
Exam tip right here, definitely memorize these 5 factors.
Yeah.
Okay, let's pull the mechanism apart on each of these. Factor 1 is the providers of capital, which we literally just touched on.
Right. The entity writing the check dictates how the expenses are reported.
Whoever holds the gold makes the rules.
Exactly. A system heavily reliant on equity markets demands hyper-transparency to keep millions of individual shareholders informed.
And a bank-reliant system.
Like Germany. It requires far less public disclosure.
Yeah.
The bank already has intimate, private access to the company's books, so public financial statements can remain relatively sparse.
Okay, so the capital source builds the reporting culture. That makes sense. And that leads directly to the second factor, political and economic ties.
Because money doesn't just flow internally, it crosses borders.
Right. And the second you start trading heavily with a specific neighbor, your accounting rules inevitably start mimicking theirs, right? To reduce friction.
Spot on. Trade requires trust, and trust requires a shared language. If a nation develops strong economic ties with a specific bloc, say the European Union, they will organically align their accounting practices with that bloc.
Because multilateral trade agreements demand it?
Exactly. You can't exist in an economic silo if you want to be in the global supply chain. You adapt your accounting art to match your most lucrative trading partners.
Okay, so capital and trade shape the rules. But the third factor actually breaks the math itself, the level of inflation.
This is a fun one.
Yeah, so for anyone who hasn't stared at a balance sheet recently, we should probably clarify the historical cost model first.
Good idea. So, historical cost is the baseline standard in stable economies. It means an asset is recorded on the balance sheet at its original purchase price.
Okay, give me an example.
Let's say a British manufacturing firm buys a warehouse in 1990 for £2 million. That warehouse sits on the books based on that initial £2 million valuation, adjusted for depreciation over time.
And in a low inflation environment, that's considered a reliable, objective way to measure value.
Exactly.
But introduce hyperinflation, and that model becomes a complete fairy tale.
Oh, completely.
Look at a country experiencing massive currency devaluation. If you leave that warehouse on the books at its 1990 purchase price, your financial statement is actively lying to the public.
Right, because the replacement cost of that warehouse today might be 2 billion local currency units.
Exactly. The historical cost model just collapses under the weight of hyperinflation.
It detaches from economic reality. Therefore, countries that chronically suffer from high inflation are forced to invent entirely different accounting measures.
They just throw historical cost out the window.
They have to. They implement complex inflation accounting frameworks that constantly reevaluate and adjust the value of assets to reflect current purchasing power.
So inflation literally forces a country to write a survival-based accounting rulebook. That is wild. All right, that brings us to factor 4, economic development.
Right. The complexity of the accounting system is entirely bottlenecked by the complexity of the economy it serves.
Because you can't implement some multi-layered, heavily regulated derivative accounting framework in an agrarian economy.
No, of course not. Highly developed nations house incredibly intricate multinational enterprises operating across dozens of sectors.
And they need sophisticated accounting to capture that.
Exactly. Plus, a developed economy has the educational infrastructure, the universities, the boards, to produce the army of highly trained accountants required to actually execute those practices.
So if a developing nation lacks both the complex corporate structures and the trained workforce, their accounting system will naturally remain rudimentary.
Right. It's a reflection of capability.
Okay, which leads to the fifth and arguably most fascinating variable. Factor 5, culture.
Ah, yes. The intangible traits.
Research argues that intangible national traits directly dictate the measurement of financial information. I love this.
It's really interesting. There are two specific cultural values that exert the greatest gravitational pull here: conservatism and secrecy.
Okay, define conservatism in this context.
Sure, some national cultures inherently view risk and optimism with deep suspicion. In a highly conservative culture, accountants will always take the most pessimistic view of asset valuations and future revenues.
So they brace for the worst.
Always. They will recognize potential losses immediately, but they will delay recognizing potential gains until the absolute last moment.
Okay, and what about the secrecy aspect?
Secrecy dictates disclosure. If a society values privacy and views the public dissemination of corporate data as a competitive disadvantage or even a cultural taboo, their financial reports will be legally compliant but aggressively opaque.
They disclose the absolute legal minimum.
Exactly. Just enough to keep the regulators at bay.
So an accounting system in a country funded by banks with high secrecy is like a spoken language that has 50 words for caution and 0 words for public transparency.
That is a brilliant analogy. Yes, that financial statement is going to be an impenetrable fortress compared to the bright, glossy, optimistic quarterly reports generated by an equity-funded, transparency-obsessed culture like the U.S.
Okay, so if we're summarizing Section 1 for the exam, the 5 factors are capital, trade ties, inflation, economic development, and culture.
Nailed it.
Now, because of these cultural differences, global investors were essentially flying blind. I mean, an investor sitting in London couldn't accurately evaluate the risk profile of a target acquisition in Tokyo because the fundamental philosophy of how to count the money was totally misaligned.
Right, which necessitated a massive global effort to standardize the language of business.
The market desperately needed a universal translator. If corporations are selling the same smartphone in Paris as they do in Peru, they absolutely have to standardize their reporting.
And that demand for information symmetry birthed the global harmonization movement.
Information symmetry. I like that term.
It just means leveling the playing field. It ensures that the provider of capital and the management utilizing that capital are looking at the exact same economic reality.
Because without it, cross-border mergers are basically just gambling.
Exactly. Corporate failures multiply because institutional investors can't conduct comparative evaluations.
Okay, so let's trace the timeline of this harmonization effort, because it is a bureaucratic marathon, and honestly, it is ripe for a sequencing question on an MBA exam.
Oh, absolutely. Know the acronyms.
It didn't happen overnight. The initial spark was actually lit way back in 1904 at the first International Congress of Accounts in St. Louis.
Yeah, the visionaries back then saw the early tremors of a globalized supply chain. They recognized the impending disaster of fragmented reporting.
But translating that vision into binding international law takes generations.
It really does. The first real structural organization didn't materialize until 1972 at the 10th International Congress in Sydney.
Right, they formed the ICTAPI, the International Coordination Committee for Accounting Profession.
But ICCAPI barely lasted a year before evolving into the ISC in 1973.
The International Accounting Standard Committee.
Yes. And the ISC carried the torch for decades, trying to herd dozens of sovereign nations toward a common set of rules.
Like herding cats.
Pretty much. But they made a massive leap in 1995 by partnering with IOSCO, the International Organization of Securities Commissions.
That was to establish core standards for cross-border listings, right?
Correct. But then you inevitably run into the problem of interpretation. Even if two countries agree on a standard, they might interpret the wording entirely differently based on local laws.
Oh, of course. So they had to form another committee.
Naturally. In 1997, they formed the SIC, the Standards Interpretations Committee, to ensure uniform application.
But the real turning point, the massive paradigm shifts that created the modern era of accounting, happened around 2001, right?
Yes. The ISC realized it lacked the structural authority to achieve true global convergence. It needed to be completely rebuilt.
So in 2001, it dissolved and reconstituted itself as the IASB, the International Accounting Standards Board.
And the universally applicable standards issued by the ISFB became known as the IFRS.
The International Financial Reporting Standards, the gold standard?
Exactly. The alphabet soup finally resulted in the IFRS.
Okay, so what are the actual goals of the IFRS? The text outlines 3 distinct, non-negotiable goals as of 2016. Pillar 1 is transparency.
Right, enhancing international comparability and quality of financial information. Transparency means removing the shadows cast by cultural secrecy.
So an investor in Singapore can look at an IFRS-compliant report from Brazil and trust the revenue recognition principles are identical.
Yes, transparency breeds trust, and trust unlocks capital.
Makes sense. Pillar 2 is accountability, closing the massive information gap between the people who provide the capital and the management teams who spend it.
Because when management operates under an obscure accounting system, they can hide inefficiencies, excessive compensation, or catastrophic failures.
And the confusing gaps between local and global reporting.
Exactly. The IFRS standardizes the data points, giving regulators the hard, unmanipulated metrics required to hold management's feet to the fire.
And Pillar 3 is economic efficiency.
The operational payoff. A single, trusted accounting language allows capital to flow to its most productive use anywhere on the globe without getting stuck in a translation bottleneck.
Plus, it decimates international reporting costs, right?
Oh, hugely. You no longer have to hire a fleet of expensive, specialized firms to prepare 30 different bespoke financial reports for 30 different national regulators.
So what does this all mean? Did the world just blindly adopt it?
Well, the world aggressively adopted the framework. Europe mandated it in 2002, Australia in 2004, China shifted in 2007. But the integration was rarely a simple copy and paste job.
And this is where the exam will likely test your understanding of implementation versus theory. Specifically, we need to dive into the Indian case study.
Yes. India provides a masterclass in how massive economies interact with global pressure. They didn't just discard their historical rulebook, they engaged in a meticulous process of adaptation.
Let's map the bureaucratic pipeline in India, because the acronyms fly fast here, too. First, the standards are formulated by the ICAI,
The Institute of Chartered Accountants of India, specifically their Accounting Standards Board.
They act as the architectural firm. They design the rules.
Right.
But they don't have the power to make them law, do they?
No. Once formulated, the standards are passed up to NACIS, the National Advisory Committee on Accounting Standards.
Okay, and NACIS sits under the Ministry of Corporate Affairs, the MCA.
Right. They review the architecture, ensure it aligns with national economic interests, and recommend it to the central government.
And if approved, the MCA formally notifies the companies, giving it the force of law under the Companies Act.
Exactly. And this pipeline experienced a seismic shock in 2013 with the revision of the Companies Act.
What changed?
Prior to 2013, the Securities and Exchange Board of India, SEBI, had the authority to let publicly traded companies optionally use the international IFRS standards. Right, but the 2013 Act stripped SEBI of that power. It centralized authority and mandated that large companies must prepare consolidated statements using a new bespoke set of rules.
The Indian Accounting Standards, or Ind AS.
Yes.
But they didn't just shock the whole economy overnight. The government rolled it out in phases, right?
Yes. On February 16, 2015, the MCA officially notified the rules, but they didn't become legally applicable until April 1, 2016.
And only for the heavyweights.
Right. The threshold was a net worth of rupees 500 crores or more. If you hit that 500 crore mark, you were forced onto the Ind AS system in 2016.
And smaller entities got an extra year. But the crucial phrase here for the exam is that Ind AS is based on and substantially converged with the IFRS.
Not adopted. Converged. That distinction is everything.
Why is it so important?
It proves that global harmonization is a negotiation, not a dictatorship. India knew they needed the transparency of the IFRS to attract foreign investment.
But they also had unique domestic realities, tax structures, banking regulations, that a rigid European model would have disrupted.
Exactly. By substantially converging, they built a financial bridge that global investors could easily walk across while still supporting their specific national economy.
Harmonization is achievable, but countries aren't just pretending to agree, they're actively negotiating the terms.
Exactly.
All right, now that we know the rules of the road, how does a multinational firm actually report its numbers? This brings us to Section 3, the mechanics. This is highly testable material.
Get your calculators ready.
For sure. If you are sitting for this exam, you must intimately understand the 2 massive operational hurdles: preparing consolidated financial statements and executing currency translations.
Let's get our hands dirty with the actual mathematics of corporate control.
Before we crunch the numbers, why build a complex web of subsidiaries anyway? Why have a U.S. parent, a Mexico manufacturing sub, an Ireland logistics sub? Why not just operate as one massive, unified global corporation?
2 reasons: taxation and litigation.
Defensive layers.
Exactly. First, structuring as distinct subsidiaries allows the parent company to legally exploit discrepancies in corporate tax rates globally. You put your IP in a near-zero tax jurisdiction and your manufacturing where there are massive employment subsidies.
And a litigation firewall.
Right. If a product manufactured by the Mexican subsidiary catastrophically fails and triggers a multi-billion-dollar lawsuit, that specific subsidiary might go bankrupt.
But they can't pierce the corporate veil to seize the U.S. parent's assets.
Usually no. It limits the blast radius of a corporate disaster.
Brilliant defensive strategy, but an absolute nightmare for a potential investor. If I want to invest in the U.S. parent, analyzing their standalone balance sheet is useless. I need a panoramic view of the entire global empire.
And that panoramic view is the consolidated financial statement. It aggregates everything into one single document, presenting them as if they were a single economic entity operating without borders.
But there's a massive trap here for the exam, the internal transaction. Let's walk through an example.
Okay, let's do it.
We'll call the U.S. parent company Firm A, an automaker. They report annual revenue of $5,000 and operating expenses of $2,000.
Got it.
Now they have a subsidiary, Firm B, that manufactures auto components. Firm B reports an annual revenue of $6,000 and expenses of $1,500.
Okay.
On the exam, they will ask you to calculate the consolidated revenue. The immediate psychological impulse is to simply add the two revenue lines together. $5,000 from Firm A plus $6,000 from Firm B equals $11,000.
And if you write 11,000 on your exam, you fail.
Hard fail. Why?
Because that simple addition ignores the reality of how these subsidiaries interact. The text will always introduce a critical piece of hidden information.
Right. Let's say during the year, Firm A purchased $500 worth of auto components directly from its own subsidiary, Firm B.
Okay, let's trace that 500. Firm B sold the components, so they recorded 500 in revenue. Firm A bought the components, so they recorded 500 as an operating expense.
Both companies properly recorded the transaction on their individual statements. What's the problem?
The problem is, a single economic entity cannot generate revenue by selling things to itself. You must only recognize revenue generated from external third parties.
Here's where it gets really interesting.
Yeah.
It's exactly like a family budget.
Huh.
If I take $20 out of my wallet and pay my brother to mow the lawn, he has $20 of revenue and I have $20 of expense.
Right.
But our household, as a combined economic unit, hasn't generated a single cent of new wealth from the outside world. The cash just moved from my pocket to his.
Exactly. And if you both report that $20 to the bank as new income to get a bigger mortgage, you are legally committing fraud.
Because we're artificially inflating the household's income. So to achieve an accurate consolidated statement, every single internal transfer must be mathematically eliminated from both sides of the ledger.
So let's run the elimination on the Firm A and Firm B scenario.
Okay, gross revenue was $11,000, but we know $500 of that was an internal sale.
So we purge the 500. 11,000 minus 500 yields a true consolidated revenue of 10,500.
Boom. Now the expenses. Gross expense was $2,000 plus $1,500, which is $3,500. But Firm A's $2,000 in expenses included the $500 they paid to Firm B.
So that money never left the corporate family. We eliminate that 500 from the expense column too. 3,500 minus 500 yields a true consolidated expense of 3,000.
The final answer for the exam. Consolidated revenue is 10,500 and consolidated expenses are 3,000.
Exactly. The trap is simple, but so easy to miss when you're stressed on a test. Always hunt down the internal transactions.
Okay, so eliminating internal transactions solves the structural problem, but what about the monetary problem? Consolidating revenue from a Japanese subsidiary means taking yen and converting it into U.S. dollars.
Yes, the volatile science of currency translation.
The text outlines two distinct methodologies, the current rate method and the temporal method.
The method a corporation chooses fundamentally alters the reality they present to the public. Let's start with the current rate method.
How does it work?
It's straightforward. It requires the parent company to translate the subsidiary's assets using the spot exchange rate that exists on the exact date the balance sheet is being prepared.
So the rate on March 30th, for example.
Right. The balance sheet date.
And the temporal method.
That operates on a completely different timeline.
Yeah.
It uses the exchange rate that existed on the historical date the asset was originally purchased.
Okay, let's revisit this scenario from the very beginning of the deep dive to see why this matters. A U.S. parent authorizes a $15,000 investment in a Japanese sub.
Right.
On January 20th, the sub uses those funds to buy a piece of equipment for 1,500,000 yen. On that specific day, the exchange rate is 0.01. So 1.5 million yen equals exactly $15,000.
Okay, now fast forward to March 30th, the end of the quarter. The U.S. parent is preparing its consolidated statement.
If they use the temporal method, the accountant looks back in time to January 20th. The rate dictated the asset was worth $15,000. So on the March 30th balance sheet, it is stubbornly locked in at $15,000.
The temporal method anchors the asset to its historical reality. But observe what happens if they use the current rate method.
They have to use the rate on March 30th. Let's say the dollar has severely depreciated against the yen. The rate has shifted from 0.01 to 0.02.
It now takes twice as many dollars to purchase the same amount of yen.
The machinery is still in the warehouse, unchanged. But when headquarters translates that 1.5 million yen back into weaker U.S. dollars using the 0.02 rate, the math dictates that the equipment is suddenly worth $30,000 on the consolidated balance sheet.
By simply shifting the translation method, the corporation has conjured $15,000 of phantom asset value out of thin air.
Purely the result of macroeconomic currency fluctuations.
Exactly. Why does this matter for an MBA? If you're evaluating a firm and you don't know which method they use, you are flying blind. You can't tell if their reported asset growth is brilliant business strategy or just a lucky swing in the Forex market.
This brings us to Section 4, the pillars of trust. Because consolidating math and translating currencies leaves a lot of room for, let's call it, creative accounting.
Oh, definitely. The art of accounting can easily mutate into the art of deception.
Which acts as a massive deterrent for global capital. If investors suspect the statements are just manipulated internal transfers and phantom currency games, they will pull their money out.
Right, which is why Feng's research stresses that transparency is the direct engine of market efficiency.
Transparency forces issues to the surface before they cause a catastrophic bankruptcy. It's a survival mechanism.
Yes, and Feng outlines 5 foundational pillars of this transparency. For the exam, you need to know these.
Pillar 1 is completeness.
Completeness demands that the picture is sufficient for an investor to make an informed decision. The most common violation isn't lying, it's omission.
Burying the massive debt of a South American sub in an unreadable footnote while highlighting European revenue.
Exactly. Pillar 2 is truthfulness.
Which seems obvious. Don't invent revenue.
Right, but it often comes down to aggressive interpretation, like recognizing revenue before a product is delivered or calling normal operating expenses one-time restructuring costs to boost quarterly profit. Sneaky. Pillar 3 is materiality. What does material actually mean to an investor?
Information is material if its omission could reasonably influence an economic decision. A $10,000 lawsuit, not material.
A patent infringement case that recalls your flagship product globally.
Violently material. True transparency prioritizes material facts.
Pillar 4 is timeliness. The text warns against information lag.
This one is lethal. If a subsidiary becomes insolvent in January, but headquarters doesn't disclose it until the December annual report.
That allows the company to solicit investments for 11 months under false pretenses. Timely info is the only defense against sudden market shocks.
And the final pillar is accessibility. It doesn't matter how complete and truthful your info is if you hide it behind a 1,000-page PDF filled with dense jargon.
Okay, so completeness, truthfulness, materiality, timeliness, accessibility. But enforcing those standards requires a massive internal cultural shift.
It does. It requires building an environment where humans are willing to actually execute on those pillars. The text leans on a framework outlining 7 steps to build a transparent culture. The steps are: encourage speaking truth to power, tell the truth yourself, practice unpleasant conversations, admit mistakes, diversify information sources, build organizational support, and the one I have to push back on, reward contrarians.
Please, push back.
Reward contrarians sounds great in textbook, but in reality, don't CEOs hate being contradicted? The corporate machine is designed to crush friction. A mid-level manager who constantly contradicts the VP is viewed as a problem, not a hero. How does a multinational firm actually incentivize this?
You're identifying the exact friction point that destroys companies. The research isn't arguing that rewarding contrarians is natural. It's arguing it's an unnatural discipline required for survival.
Because bad news doesn't naturally flow upward. It gets trapped in middle management.
Precisely. If a foreign sub realizes a new product is failing spectacularly, the local manager is terrified to report it because the global CEO personally championed it.
So the manager massages the numbers, delays the reporting, and the company hemorrhages millions in silence. The yes men literally bankrupt the firm.
Therefore, a functional multinational must engineer artificial structures to counteract human nature. You have to financially and professionally reward the friction.
Create protected channels for dissent.
Yes. Tie executive compensation to risk identification. You aggressively reward the contrarian who brings you an unpleasant conversation today because they just prevented a devastating conversation with the SEC tomorrow.
You are effectively paying a premium for an early warning radar system. That is a brilliant shift in perspective.
It is. And this internal dynamic, how HQ manages the psychology of its workforce, leads us directly into our final major concept, Section 5, the leash.
Accounting is a control system. It's not just for outside investors. It's how HQ keeps its overseas managers in line.
Exactly. The text outlines 3 steps of control. Phase 1 is to jointly determine goals.
Meaning HQ doesn't just dictate a number from New York. They negotiate a budget with the local manager.
Right. Phase 2 is monitoring performance against that budget. And Phase 3 is intervention. If the sub misses quotas, HQ uses the accounting data to justify stepping in.
Jointly determine, monitor, intervene. Clean and logical. But, as we've seen, international borders completely destabilize the math.
Oh, completely.
When HQ attempts to evaluate a foreign manager, the fluctuating exchange rate can obliterate the reality of the manager's actual competence. Let's explore how this destroys a career.
Okay.
HQ has to choose which exchange rate to use to evaluate the manager. The text gives 3 options. First, the initial rate.
The spot rate on the day the budget was drafted.
Second, the projected rate.
HQ's forecast for what the rate will be at year-end.
And third, the ending rate.
The actual spot rate on the final day of the financial year.
So HQ uses the ending rate to evaluate a manager in Japan. This manager is an operational genius. They cut waste by 20%. They expand market share. In terms of local yen, they shatter every profitability metric.
By all operational metrics, they are a superstar.
But over the year, a massive geopolitical event causes the yen to collapse against the dollar. When HQ translates that mountain of yen back into dollars using the ending rate, the massive profit evaporates into a fractional rounding error.
On the dashboard in New York, the subsidiary looks completely unprofitable. The hard variables dictate that the manager failed.
And the manager gets fired entirely because they were caught on the wrong side of a currency swing they had zero control over. It's fundamentally absurd.
It destroys morale. But the evaluation process gets even more distorted when HQ intentionally manipulates the internal economy using transfer pricing.
Transfer pricing. This is a massive topic. It's the strategic price at which goods are exchanged between internal subsidiaries.
Think of a multinational as a massive house and profit as water flowing through a complex system of pipes. Transfer pricing acts as the valves controlling where the water pools.
And HQ manually adjusts these valves for strategic objectives. Primarily aggressive tax reduction.
Right. Let's say firm A has a sub in a 40% tax country and another in a 10% tax country.
HQ wants the water to pool in the 10% jurisdiction and drain out of the 40% one.
Exactly. So HQ forces the high-tax sub to sell components to the low-tax sub at an incredibly low transfer price, at cost or even at a loss.
So the high-tax sub records zero profit and pays zero tax. The low-tax sub gets cheap components, sells the final product for a massive margin, and pays only 10% tax on a colossal profit.
HQ has legally maximized global retained earnings. They use similar tactics to shift funds out of weak currency regimes or reduce import duties.
It is the ultimate strategic superpower. But this raises an important question. What happens to the poor manager of that high-tax subsidiary?
It's a devastating paradox. Suppose HQ forces the Japanese manager to buy raw materials from a Singapore branch at an outrageously inflated transfer price just to shift profits to Singapore.
The Japanese manager's supply costs quadruple overnight. Their profit margins are annihilated.
Through absolutely no fault of their own, HQ simply turned the valve and drained the profit.
So when the annual performance review comes around, HQ looks at the hard variables. The ROI is negative, revenue targets missed. How can you possibly evaluate a human being using data that you intentionally sabotaged?
You cannot. And this is the most critical conclusion regarding control systems. You must separate the evaluation of the subsidiary from the evaluation of the manager.
Separate the math from the human.
Yes, the hard variables, the translated ROI, the consolidated margins, are vital for evaluating the subsidiary as a strategic chess piece.
They tell HQ if it still makes financial sense to operate in Japan.
Exactly. But to evaluate the competence of the manager, HQ must rely on soft variables and localized metrics.
Things they actually control: market share growth, employee turnover, defect reduction. Because if you fire a manager because your transfer pricing strategy destroyed their paper profit, you will systematically terminate your most capable operators.
You'll hollow out the talent of your entire enterprise.
That is the crucial takeaway. Separate the math from the human. Wow, we have covered an immense amount of complex terrain today.
We really have.
If you are an MBA student preparing to walk into that exam hall, let's do a rapid-fire recap. Synthesize this narrative.
The exam will test your ability to link the philosophy to the execution.
Exactly. When asked why accounting standards differ, don't just list the 5 factors: capital ties, inflation, development, culture. Explain the friction between a secretive, bank-funded German model and a transparent, equity-funded American model.
And how hyperinflation forces countries to abandon the historical cost illusion.
When discussing the IFRS, connect its evolution to cross-border investment. Explain how transparency, accountability, and economic efficiency are the antidotes to translation costs.
And utilize the Indian Ind AS rollout to show that harmonization is a strategic convergence, not blind adoption.
In the mechanics section, remember the trap. For consolidated statements, always hunt for the internal transactions and eliminate them from both revenue and expenses.
For currency translation, demonstrate how the current rate method creates phantom profits by floating with the market, while the temporal method locks asset values in the past.
Regarding the pillars of trust, understand Fung's 5 pillars: completeness, truthfulness, materiality, timeliness, accessibility.
And remember Benison O'Toole's argument that rewarding contrarians is a survival tactic against yes men.
Finally, for control systems, articulate why joint determination, monitoring, and intervention collapse if you don't separate the manager from the subsidiary.
Explain how exchange rates and transfer pricing valves distort the hard variables, making soft variable evaluations essential.
Master the connections, and the formulas will naturally fall into place. But before we wrap this up, I want to leave you with a final, provocative thought that extends beyond the textbook.
Something to ponder for your future careers.
We have spent this whole deep dive dissecting the difficulties of translating currencies on a static balance sheet date, the danger of information lag, and the math of periodic consolidated statements.
It's an entire system built around the concept of delayed reporting.
Precisely. But the technological ground beneath this system is rapidly shifting. We are entering an era dominated by digitized real-time ledgers. Imagine a supply chain running entirely on blockchain architecture, where every single transaction is recorded instantly, immutably, and transparently.
Couple that with AI systems capable of calculating real-time currency conversions and executing automated transfer pricing optimizations second by second.
It fundamentally threatens the architecture of the accounting profession as we know it today. As you step out of the classroom and into the boardroom over the next decade, you have to ask yourself, will the entire concept of a delayed static balance sheet date simply become obsolete?
Will the agonizing quarterly process of manual consolidation be replaced by a living, automated real-time dashboard?
The rigid rules you are studying right now were painstakingly built to manage an analog world. Your ultimate challenge will be adapting them to govern a frictionless digital reality.
It's going to be fascinating to watch.
It really is. Good luck on your MBA exam. Master the mechanics, understand the strategy, and we will see you on the next deep dive.